one other thing, from a commodity standpoint, I see nothing but severe global recessionary trajectories. You just look at demand for diesel, it's down. It's a recessionary trajectory. Demand for unleaded gas, it's down. Very similar to 2008-9. And demand for container boards and boxes is down. So from my standpoint, from a commodity standpoint, I see deflationary forces potentially trickling down to the equity market.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we have a great discussion lined up, and we're fortunate to have with us Mike McGlone. Mike is the senior commodity strategist at Bloomberg Intelligence. Mike, thank you so much for joining us today.
Thanks for having me, Gary. I'm looking forward to it.
So the U.S. government has normalized running a $2 to $3 trillion deficit. What happens if there's an economic downturn in this situation? How catastrophic can things get?
So first of all, I think it's less of an if. It's actually tilting that way on a global basis. It's certainly happening in China, in Europe, and Canada. And how bad it's going to get, I don't know. But that was one of the key takeaways from these debates. There's been no discussion about the runaway fiscal deficit, which is part of the reason I'm still bullish gold.
Makes a lot of sense. So you recently shared what we anticipate seldom occurs, Benjamin Disraeli consensus. No worries. The stock market usually dips in September. Then it recovers. One of my favorite charts below suggests a great reset. The chart was high rates, low volatility, reversion in gold. What I want to focus on, though, is your use of the phrase suggests great reset. Are you expecting margin calls, panic selling, et cetera? What would you speak into what you mean by great reset for us?
First of all, the background, I started writing about it about 2 years ago, just based on the normal facts of history and how things usually happen when you have massive pumps in liquidity and pumps in risk assets that go away. It's virtually 100% probability something bad will happen eventually. Speaking of that chart specifically, that's the chart that helped me make a lot of money in 2008. Now, I was early. I had a bad year in 2007. I was trading back then. At Bloomberg Intelligence, I don't trade. I have a lot of respect for people who do. I just say it. Everything I do is passive. But what that point is, the lessons I learned in the trading pits of Chicago in the 80s was volatility is always mean reverting. When it gets very low, it always goes back up. And that chart shows the 52-week average, I think I used on that one, of the VIX volatility index minus the T-bill rate. So very low volatility, very high rates. It's the lowest since that nadir right before the great financial crisis 2007. All it did is mean revert. And that's what I think is going to be happening. At some point, we're going to get reversion upward in volatility. Actually, we're going to get rates going lower. And by the time this hits the tape, the Fed will start cutting rates. But typically, it's a sign of things going down. So one thing I want to point out is you have to look over to, now that's an indication from volatility. You have to look over how relative values. And I look at the U.S. stock market on a market cap to GDP. It's 2 times GDP. Now, that's the most in 100 years. You have to go back to the 20s and 30s. If you look at U.S. stock market versus the rest of the world stock markets, the MSCI ex-U.S. index, it's the highest ever. That's about 40 years of data versus the Bloomberg commodity index, about 25-year high versus gold. It's about a 16-year high. And then for simple things like just versus its 100-week moving average, the S&P 500 is about 22% above its 100-week moving average. Going back to data since 1971, there's only been one time the Fed has started cutting rates when the stock market was that stretched. That's just a very simple stretch metric, was in the 1980s, and that turned out to be a failure. They had to go back to tightening, and then they went back to easing as the stock market went down in 81. Now, past performance is not always indicative of future returns, but the bottom line for me, everything is gold is outperforming the stock market this year for a reason. It's outperforming virtually every other commodity and most assets. I think that's partly because gold's sniffing out the reality of what's happening in the world and valuation. The U.S. stock market's most expensive in many metrics ever. And it's due for just a normal correction in a bull market. So to me, that's the macro. But that chart I wanted to show because it's not something people watch a lot, and it really was a good guidance for me for the financial crisis in 2008.
So 2 questions on that. 1 regarding volatility and 2 regarding if the Fed does a 180 halfway through. The first one being on the volatility side, if it mean reverts and we get much higher or bouncier volatility, what does that mean for everyday life for everybody? And 2, if they start down this cutting path and then they reverse course? What do you see happening there?
So to answer your first question, I think we as human beings and investors should expect what's always happened, and it's normal in history. When risk assets go up a real lot, they typically will go back down at least a little bit. They revert those prices. That's called deflation. You raise the base really high, and an average price of a home from it doubles over the last 10 years, and just take the base down a little bit. It comes out as deflation. It's where you measure it from. And the stock market's most expensive versus housing in our database going back 5 years. So it all, to me, trickles down to how much longer can the stock market stay, the U.S. stock markets, not the rest of the world, can stay this elevated. And I'm just talking about a normal correction in a bull market. So to me, that's the main axe I have to grind. And the key thing for me about, and what the other question was about what happens, or
if the Fed starts down this path of cutting rates and they do a 360 and they go back to raising rates.
Yeah, so that's one bridge at a time. For them to go back to raising rates is part of the risk, and that's where I have to tilt over to. It's kind of silly not to expect the most expensive stock market in the world not to be the only thing that matters. So people often say the economy, the economy is a stock market. No, I say now at the point where the stock market is the economy. So reason we've had recent PPI and CPI numbers, I think, come out a little bit stronger than expected is because the stock market's still elevated. So a good example of that is if it goes down 10%, that's 20% of GDP. That's the most in 100 years. That's just dollar amount. So it has to matter with people spending, with consumer sentiment, with everything. And I don't like pointing it out. I just like pointing out facts for people who, and it's typically human nature that matters. When you get these big elongated rallies, people think they're going to last forever. And I think the more prudent investors tipple to alternatives like gold, like treasuries and things, and some more risk off. So I think that's what's happening with prudent investors. We're seeing massive inflows to U.S. treasuries, as they should. They're still getting 5% in the front end and still getting 4%, about 4% in the long bond. It's finally dipped below 4%. But it means to me, I think that if statement is very unlikely, because I think what the Fed's going to do, based on my observation of Mr. Powell, who I view as profiles in courage, he pushed back on Mr. Trump, and he's been very clear and straightforward. They will start easing on September 18th, and I think they're going to go 25 and start a small cycle of rate hikes until the whites of the eyes, until the market
hikes or rate.
Oh, rate cut. Yeah, sorry. Oops. Okay. Rate cuts, yes. Yeah, what's the difference? No, sorry. They'll start the rate cuts. I think it'll be very similar to Alan Greenspan's rate hike schedule in 1994 when you have 25 basis points. And I think we're going to go down on that escalator after going up on the elevator. So, but I think the risk is if they start going aggressively to cut rates, I think that will be because the stock market's telling them to. And I think that's going to happen. Unfortunately, the situation we're in now is almost a lose-lose. Inflation's still sticky, and it's staying sticky above their targets. Now it's going down. It'll probably go down. And unemployment's going up, but a lot of the other signs of the economy are still fine. But I'll end with one statistic from my colleague Joel Levington last week. He pointed out for 34 straight months now, auto delinquencies on a year-over-year basis have been increasing. That's the most since 2009. So also one other thing, from a commodity standpoint, I see nothing but severe global recessionary trajectories. You just look at demand for diesel, it's down. It's a recessionary trajectory. Demand for unleaded gas, it's down. Very similar to 2008 and 9. And demand for container boards and boxes is down. So from my standpoint, from a commodity standpoint, I see deflationary forces potentially trickling down to the equity market.
Yeah, and there's a lot there to unpack, and we're going to go through each of them. Do you have any viewpoints on today's news about the unions, the port unions on both coasts who are wanting to strike? I mean, that can cause some not only chaos, but shortages like we saw during the pandemic with toilet paper and other things, and that would all lead to, price spikes and things of that nature.
So one thing I do, I try to not ignore anything, and things like that are just not that relevant for the macros, so overwhelming right now. Yeah. It's more minor. It's like like a lot of times you hear about disruptions in copper supply. Usually the things are just minor. You tilt over to the macros. So it's not really going to matter from my macro outlook and the way of things right now. We have the biggest, the number one thing is the Fed easing, how markets are going to react to that. And then of course the election. Those are 10th. On scales 1 to 10, everything. I don't think anything's even close right now. And of course, things you can't predict.
Well, let's stay on the easing here. The latest CPI report seems to make it clear that a 25 basis point hike, like you said, not a 50 basis point hike, is likely coming next week. It also seems to highlight the potential risks of the Fed getting things wrong and looking poorly in 2025, similar to what you said in this environment. What's your analysis of the actual Fed rate cut and if they're behind the curve, et cetera?
Well, the stock market tells us they're not behind the curve. The bond market tells us they are. So we'll find out how that pans out. My bias is with the bond market. I see deflation. So I see this U.S. government 30-year, it's finally dropped below 4%. I think it's going to gravitate towards what you're seeing in China. The government 10-year note in China is at 2.07%, and our 10-year note's 3.65. That's because of severe deflationary forces. But as far as the Fed's concerned, is Chairman Powell's pointed out they are very restrictive. 5% Fed funds versus CPI around 3% and PPI around 2% is very restrictive. But it's the delayed reaction I'm worried about happening. And I see that in commodities specifically. I pointed out in auto delinquencies. You certainly see that from mortgage brokers and seems like housing. But it's at the stage now. This is part of that unenviable cycle. There's really nothing they can do about where they are. They can't cut too much because the part of the reason that they used to say for the Fed to start hiking or cutting was to take away the punch bowl. Well, we have the most expensive stock market in history, 20% above its 100-week moving average. And going back to 1971, like I said, only 1980 did they cut rates when the stock market was that expensive, and then they had to start hiking, and then the stock market went down later, and then they started cutting. So to me, the risk is they add too much fuel to this speculative frenzy, as I'd like to say. It's just too expensive in risk assets. But the bottom line...
Are you anticipating that? Are you anticipating the fuel that they're adding is going to propel things even higher?
No, it already has. So on a one-year basis, the average 30-year mortgage has dropped from 7 to about 6, or around there, 100 basis points. The yield on the U.S. 10-year notes maybe dropped 60 basis points. The Bloomberg commodity index has dropped almost 10%. There's signs of those deflationary forces and signs of easing. The only thing that's really showing massive breakout still is the U.S. stock market. So I'm fearful of the buy the rumor, sell the fact. And so this is the most anticipated rate hike cycle I've ever seen. I started in the bond trading futures in the 80s. And so it's already priced in. And like I said, we're already, so that far stretched above like a 100-week moving average is kind of expensive and scary. And then we have this very contentious election coming up. We do not know for sure we'll have a, what makes America great is a clean change of leadership, because we do have a candidate who's still claiming he won the last election. And so this might get contentious. So there's a lot of reasons I think you're always looking for, basically let's put it this way, when you see volatility this low and risk assets this high, and most other indications say that we're heading towards recession, you look for sparks. I don't know what that spark's going to be. I do have to point out we do have Cold War 2.0 getting hotter and hotter. Most of us grew up during the détente period starting when the Soviet Union collapsed. So that's completely reversed. And things can happen, but I just look at the relative valuations, and the indicators show you part of the reason why I'm still bullish gold. And I'm very worried that there's going to be pain like we started earlier. And I had the same feeling in 2007. And just when I see that potential coming, it's my duty to warn people. Here's the thing I like to say is last year I earned this nickname by a colleague, Mike McGlone. I could say, no, I'm McFacts.
Okay. All right. Good retort. All right. So, Mike, the BRICS nations' effort to de-dollarize the global economy, it's gaining some momentum as evidenced by their increasing use of alternative currencies for trade settlements. The shift has now raised some concerns in the U.S., despite its currently happening on the margins. The concern is being demonstrated by Trump's recent threat to impose the 100% tariff on countries that circumvent the dollar. And there's many of them. What, in your opinion, are the potential implications of this de-dollarization trend that you're watching out for?
So I'm glad you tilted there. That's Cold War 2.0 kicking in. It started out with two people, and it's not the countries of China or Russia with respect to their histories and their future. It's two people, President Xi's unlimited friendship with President Putin. The day that happened was the day I said, gold's going nowhere but up. And that was Q1 2022. It's going to continue, it's accelerating, but I fully expect that's going to fail completely. Autocratic leading economies and countries never succeed, partly because they just become a bunch of yes men. They have no clue what's going on in the real world. They don't have that that value added that I provide about what to really look at in markets, because they have to only be told what they're told. But I'm not worried about that at all. And I like say, good luck with that one. You're talking about the United States. I heard it from an economist once who said, in the last 100 years, if you wanted to be wealthy in the world, you cozy up the U.S. and don't do the opposite. Now, they've already made that mistake. So obviously I'm American, I'm a bit biased, but I just like to point out the facts of the dollar. The dollar is unstoppable as a global reserve currency right now. Certainly when you look at US T-bills at 5%, the debt to GDP is a bit high, but there's 100 countries who are net exporters to US. Maybe a handful that actually are net importers from the US. The world's more dependent on the US than ever. And then I like to tilt over one of the best indications for the dollars, cryptocurrencies. I love how Mr. Trump has finally tilted over that. I wrote 5 years ago that virtually everybody in this country should be favorable to cryptocurrencies, because there was a organic new technology. People hear about Bitcoin and stuff. The most widely traded crypto is the dollar. It's a dollar token called Tether. This whole space went organically on a global basis to cryptocurrencies. Why? Because there's nothing even close. So I like to say, yeah, good luck with that one. Every country in the world should have a right to trade in whatever currency they want, but there's still no better, on a scale 1 to 10, currency in the world. And for fiat currencies, there's the dollar, and there's everything else. Even the euro is probably about a 5 or 6 and below. It's just nothing even close. And then you look at I'll end with this. I love Jamie Dimon's take on when the U.S. was downgraded. Was it Fitch this time? He said every other country that's still AAA is under the military protection of the United States. And by the way, almost all of them are exporters to the U.S. So good luck with that one, and thank you. And you're welcome, like I say. But I'm still, I say maybe it's patriotism, but I think it's more factual. Just look what's happening in the world. And but no, I'm not worried about that. I think also, and I will put out, I think I do, as part of my whole bias, I always have to have views on politics. I think Mrs. Harris will be elected. I think that the country's not going to reelect President Trump, and that's a key factor there. It'll be a re-election versus someone new and different and young versus someone who seems old and grouchy.
So, Mike, based on your worldview bias, as you put it, if you had to compare the current market setup, would you say it looks maybe more like 1995, 1999, or some other period altogether? 1929,
unfortunately. I started pointing this out. We were in the 1930s, heading there. First of all, market cap to GDP. It's very similar to the 1920s on the way up, 1930s on the way down. That's a fact. We were about 60 trillion GDP, and I'm sorry, market cap. Now they're like 57 or so. And US GDP is like 28. Okay, so maybe that model doesn't work, the Buffett model, but what's Buffett doing? He's way overweight equities, treasuries and cash for a reason. So I think it's very seriously heading towards a global recession. That's certainly what's the case from commodities. So look at gold on a one-year basis. It's up 35%. Crude oil's down 20%. S&P 500 is up only 27%. So gold's beating the S&P 500, this AI-driven beta, on a 1, 2, and 3 year basis. So to me, that's a global recessionary trajectory, and it's very clear where it's centered on in one country, China. To me, China is a very much combination of what happened to the former Soviet Union and Japan about 30 years ago. And I worked for Japanese firms back then. I saw Japanese economy jumped up to 4 trillion GDP really quick. It's been the same for 30 years. Now, that's what I think is happening to China. So right now, they say they have 5% GDP growth. I think that's fully can expect to tilt negative. And like I say, tilt over, look at their bond yields. When you have an autocratic leader like that, it's kind of hard to trust the data. And you know they're misallocating capital. It's impossible not to. But you can't fake the math of a treasury yield 10-year at 2.07. Of course, and I read on the terminal every day, there's things called BI, BI China and NI China, and everything I get from my colleagues is this property crisis is worse than Japan's was at the peak. It's definitely worse than the U.S. And everything's tilting towards what you'd expect in a normal reversion of a rapidly advancing emerging market and piss off its best customers by being a decisive enabler of a war in their backyard, which is the quote from NATO. So it's sad. I'm not making that up, but it's the facts of what I think has happened. We are no longer in that détente period we had for 3 years. We are tilting over to Cold War 2.0, and it's getting hotter every day.
So let's shift over to unemployment for a moment. Unemployment in this cycle bottomed around 3.4%. It's currently sitting around 4.3%. The average unemployment spike higher in cycles going back to the 1950s is about 3.6%. If we have a garden variety recession, as Stanley Druckenmiller calls it, then unemployment would likely rise to the 7 to 7.5% range. If we get something worse than garden variety, well, unemployment can rise much higher. Either way, we are literally talking millions of people being put out of work. Based on your previous comment about comparing it to the late 20s and the 30s, are you expecting unemployment to go much higher than the garden variety 7 to 7.5% range?
Well, I appreciate you going a little bit above that normal reversion to 6%, which would be a bit of a shocker. And it's what I like to point as the biggest risk here is, I don't know, one bridge at a time, but on 100% probability since 1947, as long as we have data, unemployment, when it bottoms from around that level, which was the lowest since 1968, it always goes to at least 6%. So Bloomberg Economics expects 5% by the end of next year, which is a severe recessionary trajectory. Now, that's why I point out there's going to be pain, yet people are not prepared for it. So I don't know how it goes. One bridge at a time. Right now it's going up, which is see what the next step is. The thing I'm really concerned about is this massive wealth effect, and a lot of people not accustomed to what happens when you have a little reversion in the wealth effect. Now, some of us have lived through a few of those, and at this juncture, I just don't see what stops it. Now, we've already pretty much maxed out on fiscal spending. It's 7% of GDP, the most during any outside of any war or recession, which you pointed out earlier. Monetary policy, I think it's going to partly be why I'm still very bullish gold and long bonds, because I think monetary policy is going to follow unemployment up with rates going lower. But it's a question of what I like to end with is the simple facts of mean reversion is a powerful force. What was the 1987 stock market crash? It's just mean reversion. That was it. What was the 1929 crash? Mean reversion. What was 2000? What was 2008? All simple mean reversion factors. Volatility so low, markets so high, interest rates so high, will just revert a little bit, and it'll feel like a crash. So that's why I think everything starts with one iteration. It's already started, but the number one major iteration is the U.S. stock market. It's just never been this expensive in history of most people alive, and I mentioned certainly versus most other assets. And you can use other measures like earnings and things like that. I'd like to point out versus most other assets. And I look around where I am and can't really see them. I'm looking in Miami, all these condos. We've just gone up so much on the biggest money pump in history. And there's a book called The Price of Time by Edward Chancellor, just pointed out all the histories of money pumps that dump, and pointed out how China is a key dumping area. There's another book called The Boom and Bust. Quinn was his name. I can mention a couple other ones, but it's that process of reverting from that massive pump that I think we're heading towards now. And I have to admit, some of our viewers will say, McGlone, you said that a year ago. I was like, absolutely right. But I'll end with Roger Babson's quote in 1929, who was bearish and named Babson College out of him, is, I will repeat what I said to you last year and the year before. Now, I used that quote at the end of last year about the price of gold. I'll repeat, I've been bullish gold for too long. Finally, it's breaking out. But it was nice that some people took that, yeah, McGlone, you were early, but it's going the right way.
So, Mike, so whether unemployment goes to 5%, 6%, 7.5%, or even higher, are you concerned this time around versus all the other cycles because of robotics and AI, and that may be preventing some of the workforce from re-entering because they won't be trained now, or because their jobs will be lost?
So that's part of the paradigm shifts that's happening in global markets. That's another book, The Price of Tomorrow by Jeff Booth. New York Times bestseller, I consider him a friend. He pointed out how technology is moving so fast now. Look what happened to Intel. It was the darling just 20 years ago. Boom, poof, it's gone. I used to work in a trading pitch in Chicago. Poof, they're gone. It's just what's happening. You have to expect that to continue. And I think AI is accelerating so fast, we're going to see some deflationary forces from that. Jobs taken out. You saw that recently with the some of the strikes. I think it was for Boeing and the shipping, not happy with everything is having some kind of technology replacement. But that's been since the history of mankind. So one thing that's really obvious is in the corn belt and the grains. The average production, average acre of corn in this country is going to produce 184 bushels of corn per acre. In 1973-74, when we had a big, it was called the Great Grain Robbery. Soviet Union imported a lot of corn and grains from the U.S. It was half that. We've doubled. The average 1 acre of land has doubled the production grain, and we use less fertilizer. How is that? rapidly advancing technology. Yes, genetically modified seeds, but all the technology around it, the GPS and the drones and everything, it's happening everywhere. So from a commodity standpoint, I look at it, technology is replacing petroleum and crude oil, pressuring it much lower, and continue to do that. Part of that, some of it, the bid for copper, but it's also bringing on that massive supply of things we use every day and need, food and energy. But from an overall standpoint, that's deflationary forces, and it's just happening quicker in commodities, and that's where I look at is when unemployment continues to rise, that potential is going to accelerate these already existing deflationary forces.
So in a recent post on X, you stated gold beating the U.S. stock market and most commodities falling is a global recessionary trajectory. Yeah. You've talked about that here a little bit. And you also stated, can beta avoid a normal correction and buoy most boats, or is lagging Bitcoin signaling that the race is over? So is your analysis pointing to let me put it this way, what kind of recession is your analysis pointing to?
One thing, Gary, I do appreciate your kindness and how you phrase your questions, and our banter is fun. That's the key thing. I don't know. So from my standpoint right now is, I look at it as the number one thing is I'm a market strategist. This is where I think markets are going and why. And I'm worried about what that means for pain. So the bottom line is, let's look at the facts. We've never had a point in any of our lifetimes where we've been so much more dependent on stock market staying elevated. There's obviously 401ks, retirees, so many people. And that wealth effect is the most ever. We saw the biggest inflation pump in most of our lifetimes. Now, you and I who lived through the 70s have seen it, but we were kids. It's all tilting tilt lower. And the question is, how much lower is it going to go? I like to point out I'll give you some specific examples. It would be weird for me if crude oil doesn't go back to $40 a barrel, because it's what it's been doing since 2008. It's what it's done since the peak in the Iran-Iraq war. And there's every indication, certainly with China, in decline to do that. I think it's just a matter of time. The gold gets to $3,000 a pound. I'm sorry, an ounce, based on just those normal trajectories we're seeing. But to me, one bridge at a time. The first bridge, next iteration is just to see a little back and fill in the stock market. The first 10% correction. And so I wrote about this starting in March. Just show me a test. And we already had 5%, but already show me what happened. When that happened, gold shot up, crude oil, Bitcoin, all the risk assets went down. And then it started recovering. So to me, that was a shot across the bow. Even on August 5th, we had that big swoon. Everything was just another shot across the bow. To me, the big one's going to be when we have a normal 10% correction. I say normal because that always happens in bull markets. We have a bull market. We haven't had a 10% correction since that bottom back in Q1. So to me, that's the next big iteration. I think anybody running money right now should have underweight risk assets and just be waiting for that next iteration. And overweight risk assets, it's nice when you can say treasuries and get 5%, because I don't think we're going to be saying that this time next year. It might be 3 or less. And it'll be wonderful if this keeps rising, but it's just against virtually every cycle in history, and it's certainly against the lessons of human nature.
The underweighting risk assets seems to be happening over at Buffett's Berkshire Hathaway. Yeah. Do you remember 2009 when he was just laying into equities? I just remember that vividly, like, okay, I'll follow that trade. I think right now, but I know you were going to go on a question on that. I want to give you one fact. A lot of people hear about high, the amount of money in money market funds. It's around $6 trillion. That is about 10% of the market cap of the S&P 500. Before the financial crisis, it was closer to 15%. So right now, Mr. Berkshire Hathaway, Mr. Buffett, is a bit of an anomaly compared to the broad market. Interesting. So in another post on X, you shared a double top that nobody wants, the S&P versus gold, right? Yeah, on a total return basis, the S&P has never been higher versus spot commodities and the rest of the world's stock markets. Its potential for a double top from the 21 and 24 highs in the SPX gold ratio. It's what you find the most unsettling about the graphic. If it truly has topped and it falls, how deep of a fall are you worried about here? So like what's the reversion of the mean look like?
1-to-1. So here's the problem, and this is where I say mean reversion can be the most powerful force in all markets. Typically, historically, depending on how far back you can go, we can start with when President Nixon took us off the gold reserve in 1971. Is typically the S&P 500 and gold, the ratio between the ounces of gold and the S&P 500 is about 1-to-1. Right now, it's 2.2-to-1. So what happens virtually every time we've been in a recession when it's that high? No, it can get higher, it can stay high, and it has for a while. Anytime we get in a recession and gold's that expensive, I'm sorry, S&P 500 is that expensive versus gold, they just revert. So I was looking at this a year ago. I said, they can easily both get to 3,000. That wasn't very profound. Now the S&P 500 getting to 3,000 is very significantly difficult for people to take. But the low during COVID was around 3,600. Actually, what's below 3,000, but on the way back down in 2022. But gold going to 3,000 is nothing. It's already only at 20 as we speak on the 13th, Friday the 13th. It's almost 2,600.
So what's the S&P at right now?
At 46. Oh, sorry, 56.
56. That's a huge. We're talking almost 50% drop there.
Well, that's what happened in 2000 to 2002, and then 2000, about that from 2007 to the peak to 2009. I mean, we've had recent examples. The thing is now it's more expensive than ever. Volatility's lowered, certainly versus but the rest of the world and versus GDP. And that's why I'm very fearful. And it's also on the back of the one key lesson I think we've learned, another lesson from Jeff Booth, The Price of Tomorrow, is humans are about error correction. We make errors and we correct ourselves. The error we made during COVID, when we all thought, a lot of us thought we were going to die, is way too much liquidity and inflation that resulted from that. Yes, there were supply bottlenecks. We just pumped way too much money in the system, writing checks to people. Money supply pumped up to 40%. Now it's only up 35%. Since that point. And now we're in the hangover should happen. If we don't, it'll be the first time in history. And if it doesn't happen soon, it's going to happen eventually. It's always the way it's worked. So I think the fact is we've learned that lesson. Now, here's what I think now is going to happen is as we tilt towards a deflationary recession, there'll be pushback like there's been in Germany since the Weimar Republic, those of us who remember the Bundesbank, that we can't cut rates too much because we might risk creating that inflation we did by cutting and pumping too much liquidity in the system to the peak in 2022. To me, that's the cat and mouse game that's going to get started. And that's what I'm seeing in what you mentioned, gold outperforming versus all risk assets, most notably commodities, most notably crude oil, copper, and bond yields declining. And to me, that's that sign that it's just going to happen. So I'll end with this, the inverted yield curve. David Rosenberg, one of my favorite economists, he said if he was stuck on a desert island, he'd want one indicator, it's the yield curve. So the measure I like to look at the yield curve is where I started in the business. The U.S. 30-year long bond at 4% and Fed funds at 5.25, still 125 basis points inverted. It will always disinvert and go back to something where long bonds are higher than Fed funds. But I like to do the other day, I pointed out since the beginning of crude oil futures in 1983, no traders have ever seen a curve this inverted for that long that's going to go up that much. So to me, that's how historic this is. I use crude oil as an example because I think crude oil is going to keep going down and gold keep going up. But that to me is how historic this is the curve is going to disinvert, it's going to normalize, and it's going to do it from the longest, steepest period in most of our lifetimes.
Amazing. Well, it's now time for our Golden Nugget segment, which is sponsored by the Naples Family Office Symposium, and where Mike will be a featured speaker at. It'll be held this year in Naples, Florida on October 3rd and 4th. The Naples Symposium is focused on uniting family offices, wealth managers, and other sophisticated investors with leading experts adept at navigating today's intricate market dynamics. So go check out the Naples Symposium. Links are in the description area. Okay, Mike, let's discuss deflation a little bit deeper. There have been two times in history where the economy moved into strong deflation, the 1929 and into the 1930s, Great Depression, and the 2008 Great Financial Crisis. What can we expect both in terms of the markets and the economy if it once again moves into deflation? And how long will the Fed allow that to happen before acting, in your opinion?
Unfortunately, it's less of an if and it's more of a when. I think it's happening now. It's happening global. It's happening in China. U.S., it's just a matter of time that follows it. I don't know how long, how far it lasts, but to me, the parallels are very similar to both of those periods. And the big difference is we've had this massive pump in inflation, so the Fed has to be careful pumping too much liquidity in the system to not recreate that. And we're at the highest fiscal deficit spending we've had. So it's McGlone was pointing out McFacts.
So on the McFacts side, what can the people on the ground expect? What can the people, what are they going to feel, in their everyday lives?
Just a reversion of the wealth effect we've had for over the last 15 years, meaning average home value should probably go down. Stock market should probably I shouldn't say go down, revert, drop a little bit back to where should be higher unemployment, virtually a lot of deflation in prices. And that I expect the price of gasoline to drop to well below 3, maybe 2 and change. So that'll be helpful. But you'll see unemployment. And unfortunately, I think a lot of people will feel a lot less wealthy, and that's where the trickle down kicks in. And it's not unusual to say that. It's always a matter of when. We've just never been this expensive, at least in like the last 100 years in terms of risk assets. But it's also the foundation I find very disconcerting. So I think it's important for people to prepare for it, and it's probably much better to be prepared than not prepared.
So with the law of diminishing returns, Mike, can the Fed come in, with their helicopter money and save the day this time around, or is it getting harder and harder for them to do that? Point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview like this one that we conduct, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Mike as much as I have. Please let him know by hitting the like and subscribe button and leave a comment below the video.